Hello everyone, we are starting the meeting now. Speak sitting there. It's okay, you can use this.
Good evening, everybody. A warm welcome to all of you for joining our session today. So today's session is all about why it's important to cut our losses. So we will talk about how do we spot weakness in charts and how do we sell them before our losses become too high. So today's topic is all about defensive selling. Defensive selling means that we are trying to sell positions as we start to see signs of weakness in that stock. So before we start, please just go over this disclaimer. So today's session is only for educational purposes. Please don't take any of the examples that we provide today as buy or sell recommendations. Our objective here is to try and teach you certain principles that we use when we sell stocks portfolios, and hopefully you will be able to use these principles in your own investing. And of course, you need to make your own. You need to do your own research before taking any kind of action in the market. Okay, so moving on, here are some of the few things that we'll be talking about. Like I mentioned, here we are talking about defensive selling. So in this session, we are talking about how do we sell in order to protect ourselves from bigger losses. And there is more to selling, of course. We also sell to book profits. So in our next session, we'll be talking about that. We'll talk about how to sell stocks and in order to lock in our profits. Before we start with the content, we'll just go over what the market has been doing since our last session. So over the past 2 weeks, what has Indian markets been up to? So for that, I'll hand it over to my colleague Raghav, who's a part of the Markets with India team here.
Hello everyone. It's been 2 weeks since we have met last, and it's been a very eventful 2 weeks. We have seen that markets have retracted from their highs, and post that there's been some consolidation of both the key indices, both the Sensex and Nifty. They have recorded the 52 and all-time highs around the mid of March. Post that there's been some retraction. They have corrected a bit. This was because there was some weak global views around the world. The healthcare bill, which was supposed to be passed in the US, could not be passed, and Trump government faced some setback. Because of this, most of the Asian indices and stock exchanges were under pressure. Similar thing was observed in Indian markets as well. However, after that, after last week of March, the first week of April has been a very good week. Both the indices have made back all have recovered well, and gained back all the losses which they have made in the earlier week. Yesterday we've seen that markets have recorded all-time highs. Both the Sensex and Nifty closed at their all-time highs. Though Sensex is just below its intraday high of the 30,000 mark, that is sure to be achieved in the next couple of days. So this shows the strength in the underlying Indian market. Even the broader indices have, even before the key indices have scaled new highs, we've seen that broader indices, both the Sensex, both the Nifty mid cap and small cap indices have reached their all-time highs. They've been extending their highs even in this week. So all the key indices as well as broader indices are now trading at their all-time highs. This shows that the markets are currently very strong. It is an ideal market condition where we have to make new investments. Along with the indices, we see that a lot of stocks are breaking out from their base patterns and they're making new highs. So whenever a stock breaks out of a new pattern, that is when it's an ideal entry point. So that is when we are supposed to take new positions. So we have seen most of the stock make new highs, and this is the ideal time to screen stock which are doing good fundamentally and technically, and take new positions in those. So going forward, I think the next catalyst for the markets would be the interest rate decision that is due on this Thursday. So markets are looking towards that, and in the next couple of sessions, we expect that investors would be on the sideline just awaiting the results of these of the interest rate decision by the RBI. So after that also, now that the financial year has ended, we see that we will be coming across the earnings season. So mid of April, we'll see a surge in earnings releases. So that is when markets turn to be volatile. And in this condition, we suggest that investors should be cautious and just be careful of taking new positions just before an earning release, maybe 3 days before an earnings release. Be more cautious of what positions you take, because if the earnings are not in line with market expectations, you can see a sudden spike up or a spike down. So that is what we expect in the coming future.
Okay, so getting back to our topic for today, first of all, when it comes to selling, especially when it comes to defensive selling, we need to be very aware that everybody makes mistakes in the stock market. So even those big portfolio managers that you hear about, even well-known mutual funds, they all make wrong decisions once in a while. So it is not that you will always get your you will not get all your investment decisions right. So there will be cases when you would have picked the wrong stock, or you would have timed it the wrong way. But the point is, when we do make mistakes, we need to make sure that our losses remain small. So of course, to make big profits, we need to keep our losses small. So even if you're right only for half the time, you're only right 50% of the time in terms of your stock picking, or if you're right only 40% of the time even in terms of your stock picking. If you are able to limit your losses to a small percentage, and if you are able to hold on to your gains for a longer period of time, that would mean that overall you would be in profits in your portfolio. So that is one concept. We need to always be aware that wrong decisions are made and mistakes can happen. So never let your ego get the better of you. And we should be ready for the fact that the stock that we might have bought may not have been a good buy. Of course, this is another concept that a lot of people have. I mean, a lot of people get really attached to some of their stocks. Like for example, if you had bought something like TCS or Infosys during the IPO days and you made a really big amount of money from them, that if you had really invested a lot in one of those stocks in the initial days, that means that that company has really changed your life for you. It would have been a kind of life-changing investment decision. And when such kind of things happen, that's when people kind of get really attached to their stocks, or they marry their stocks, so to speak. So we always, at MarketSmith, we always say that the whole reason that we invest in markets is to make profits. So if we buy a stock and it's consolidating for a long time, or it ends up in losses, then there is really no point in holding on to that, because the whole reason is that we want to get some profits when we buy our stocks. So we need to always be ready to dump the stock when we see signs of trouble. And of course, we should not let our emotions take over, and we need to be able to evaluate our situations in a very rational way. So now, how do we evaluate our buy decisions in a rational way? We'll talk about all those in the following slides, and also we'll look at a lot of examples where we'll see that by not getting emotional and by just looking at the facts. By facts, I mean by looking at price and volume action on the chart, we are able to make sell decisions that protect us from further losses. So here is another concept that a lot of people have. So especially if you have come from this value-oriented school of investing, you might have this thinking in your head that the stock can't go any lower. So you might have figured out a fair value for a particular company, and you might believe that it's already below that fair value, and there is no way that it's going to go much lower from here. Or on the other side, you may be observing a stock for some time, and you may have seen it trade in a particular range, and now it has come much lower, and you're still holding on to that position. You might think that I'm just going to wait until it goes back up, because I've seen it at that price before. For sure, it's going to come back to that price at some point. So now there are a lot of pitfalls if you're going to think in this kind of way. Now the problem with it can't go any lower is just simply false, because it can always go lower than what you think is low. You never know what really low means in the market, because even if you have identified what you think is a fair value, it's not necessary that all the other investors agree with you. So it can always go even lower than what you think is the right price. And it can even go to zero as well, because after all, we are talking about stocks here, and companies can and it does happen that companies go bankrupt. So that's always an extreme possibility, but yes, that's also a possibility that you need to keep in mind. And if you're thinking that I'll just wait until it goes back up, now the problem with that is, how long are you really willing to wait? You need to remember that we are all retail investors here, and sitting on an investment that does not move for 2 years or 1 year, that can be really painful to us. We can really lose our patience, and that can cause us to make irrational decisions. So there is, again, coming back to what I said, there is no point sitting on any stock that is not making profits for you, because the whole idea of buying stocks is to get gains.
So moving over to one example here, this is a chart, weekly chart of Tata Elxsi. Here we see that Tata Elxsi has been had a really good run. It has moved up almost. It has moved. It has trended up in a nice way, and around this point, this is where it broke out of a cup pattern, and around this point we have entered this position. We have took a position in the stocks. So at this point, however, we see that around 3 weeks after this, the stock started to retract, and it almost gave up 8% in 3 weeks time. So around this time, we could have waited longer, and we could have said that the stock might come back up, and we could have waited for it to come back. So in the general market, most of the investors does the same mistake. That is, they expect the stock to pull back up and hold on to the stocks even in spite of seeing losses. So when you do that, it so happens that the losses might go deeper, and it might affect the overall portfolio. So in this case, we see that the stock has gone about 8% down, and however, it slightly pulled back up. And in the long term, in about next 6 months, we saw that the stock has slowly started to change its trend. It started to decline slowly, and in a span of about 4 to 5 months, the stock declined 50%. So if we would have kept this in our portfolio, it would have hurt our returns, and this is the example of what Arun was speaking of earlier in the earlier slides.
I see a few questions here. So one of them is this a weekly chart? So yes, this is a weekly chart. So what you see, each bar you see here would represent 1 week. And I also see somebody is asking why the buy point became a resistance level. Now, what we keep in mind, of course, is that the way our methodology works is that our buy point is always at such a point that the probability of the stock going higher is more. Now that said, it does not mean that all the buy decisions that we make are going to be right. Like I said, we all make mistakes from time to time. At the time that we added this to our portfolio, it had all the characteristics of a canceling stock. It had great earnings and sales growth. It had a good story behind it, and it looked all ready to go higher. But it turned out that it actually fell from there. So now, what do we do in such a situation? Uh, of course, what we say is don't try to argue with the market. If the idea does not work, we need to accept that we could have been wrong, or we would have timed it wrong in this particular case, and so we need to get out. And so you can see very clearly here that by getting out early, we protected ourselves from huge losses. Okay, so here is another mistake that I see a lot of people usually make. In fact, I was just talking to my landlord a few days back, and he's a retired gentleman, and he's actually trained as a cost accountant. So what he was telling me is that he always looks at the realized gains and losses in his portfolio. So he was telling me that when he sees profits in his portfolio, he tries to book them as soon as possible so that he can build an income statement saying that his investment has fetched him good returns, and he keeps unrealized losses in his portfolio. So his portfolio, most of the names would be negative, and when one of them turns positive, he would be exiting it and booking those profits. Now it sounds reasonable if you think about it from an accounting perspective, in the sense that you are booking your profits and getting money out of your investments. But if you look at the larger picture, what you're really doing is you have bought a certain number of stocks. Some of them have worked out for you and some of them have not worked out for you. Now, if you sell your winners, you are really selling the stocks that have worked out for you, and you are holding on to the stocks that have not worked out for you. So the good decisions that you made, you're getting out of those. Whereas the bad decisions that you made, you're keeping them in your portfolio for a long period of time. So that can really, because you cannot just hold on to those losses forever, just because it is an unrealized loss. At some point, you will have to get out of it. So you cannot just hold on to that unrealized loss for an extended period of time. So what we say is that you need to continually weed out your portfolio by selling our worst performing stocks. So think of it like for example, you're coaching a cricket team. The players that you want to have in your playing 11 are going to be the best players that you have. So the best players are going to be the ones that are going to be playing in your team, whereas the players who are not performing so well, you want to have them on the bench, or maybe you don't want to have them on your team at all. So that you need to have that similar kind of approach when dealing with your portfolio as well. So the good decisions that we make, or the stocks that have been making gains for you, we need to hold on to them for a longer period of time, as long as we can. And the stocks that are making losses or not moving much, we need to get rid of them. And here is how we actually make our sell decisions. So we went over in our prior sessions how we decide our buy decision. So when it comes to buying stocks, we talk about earnings and sales growth. We look at the fundamental profile of the company. We look at the end factor, what is new about this company, and why are people excited about it. And also we look at market condition, and we look at the chart pattern. We buy when it's breaking out of the right pattern, and so on. But when it comes to selling stocks, it's a lot more simple really. What we focus on is only the technical. So we watch out for signs of technical weakness, and when we do see signs of technical weakness, that's when we get out. Now there's a reason for focusing on fundamentals and not on there is a reason for focusing on technicals and not focusing too much on fundamentals while selling stocks. Now the reason is that fundamentals of the company will change. That by the time something changes, it will take there will be a time lag between when something changes and when you as a retail investor will get to know about it. So there is always going to be this lack of information as a retail investor. You will never have perfect information, knowing that what exactly is happening with this company at this point in time. So there are very few people in the market, those large portfolio managers and those large mutual funds. Those are the people who will really have that kind of in-depth and up-to-date, complete type of information. As retail people, it's very difficult for us to have that kind of information. And but on the positive side, all information that is there about that stock is going to get reflected on that chart. So if something is going wrong with that company, you will see the chart will start to weaken first. So what we say here in MarketSmith is that the technicals always lead the fundamentals. So before you notice something changing fundamentally with that company, you will see that the chart will start changing its character. So the chart will change, the technical characteristics of that stock will change before the fundamental characteristics change. So we'll see an example where that is very much evident.
So this is a monthly chart of Kelton Tech. So this stock has given good returns in a short span of time. We see that the stock has spiked up well, and it is towering well above its 50 and 200-day moving averages. And the technicals, the fundamentals for the stock have been very strong. The company has consistently delivered triple-digit top line and bottom line growth in the several quarters. So this stock, it had nothing, fundamentally there was nothing wrong about this stock. However, we saw that after it topped at this stage, the stock started to come under pressure. It corrected like heavily on high volumes. There was heavy distribution in spite of having a good fundamental base. So this often happens. So even in some cases we see that stocks show technical weakness before the fundamental weakness is shown. So this is one classic case where we see that the stock ran well, and after that it topped at a point and started to retract from there. So yeah.
That's right, Raghav. In fact, what we see here is that if you were just looking at sales and profit, so if you were studying this company just based on its income statement and looking at sales and profit changes, it looks very good. It looks like a perfect Cancelam stock with very strong growth in earnings and very strong growth in sales as well. But there is some discrepancy between these fundamental characteristics and what you see the chart was doing at that time. So the stock was correcting, but there was nothing wrong with the company from a fundamental standpoint. So this is a very clear example of how the technicals will change before you see anything wrong happening in the fundamentals. Another very important thing to keep in mind is when talking about selling stocks, especially when talking about defensive selling, is that we need to be sure that we are buying stocks at the right time. Now, when it comes to our methodology, especially when it comes to base patterns and how we identify the pivot price and how we buy stocks when they break out of a proper base pattern. So all that research is done, and we have found out that when we buy stocks breaking out of particular base patterns, the probability of the stock moving higher is better. So what we typically like to see is that as soon as we buy a stock, it would be moving up. But if it does not do that, now that is when we need to be a little more careful. So if you see that you are buying stocks, and if you see that as soon as you buy, it's coming into losses. Now there may be a few things going on. One thing is that we did not pick the right stock. It could have been a mistake from the stock picking standpoint, or it could have been that we did not follow the methodology properly. It can be that we did not buy when the market is in an uptrend. So we said that we always buy when the market is going up. So we said that when most of the stocks tend to follow the market direction. So we always try to maximize our probability by buying stocks when the market is in a confirmed uptrend. And we need to buy at the right buy point. So if you buy a stock by chasing it up, by that I mean that it's already extended 5% beyond its pivot price, and then you make a position. Now it can be that it can decline from there. Now that decline does not mean anything unhealthy. It's just that you have bought it late, and as a result, you are having losses in your portfolio. Also, you might have bought it too early. You might have bought it before there was a clear breakout. So now in that case, what will happen is that stock has not really broken out, but you have bought it. Now it can reach to that pivot price and then correct slightly. Now remember that the pivot price is basically it's the last resistance level that we look for. Now given that it's a resistance level, it can always reach that level and fall back. So if you buy it before the pivot, it can actually continue consolidating for a long period of time before you actually reach into profits. So these three things we need to keep in mind. If you notice that you are buying stocks and it's immediately falling into losses, of course, one thing is obviously the idea was not a good idea. The other possibilities is that the market condition was not right. The market could be in a correction, or either you bought it too late or you bought it too early. So be sure to keep these things in mind to make sure that the odds are in our favor when we make our buying decisions. Okay, coming to the next big rule about selling. Now we call this the Cardinal rule here. This is something that it's actually kind of difficult to follow. So it kind of hurts your ego to some extent. So you might make a good buy. You might have bought a stock at the right time. You might have bought it when it breaks out of the right base pattern. You have identified all the fundamental and technical characteristics, and yet the price drops below your purchase level. Now, like I said, everybody makes mistakes. This can always happen. We need to accept that these things are going to happen once in a while in all the trades that we do are not going to be profitable, and some of them will go wrong. So that which is why we always follow this 7 to 8% stop loss rule. Now, why is it 7 to 8%? Now, what we have seen based on our historical studies is that the really good stocks or the winning stocks that make really big gains, they rarely correct more than 8% from their buy points. So if you had bought it at the pivot price, it is a very rare situation that it would correct below 8%, given that it's a good stock. So now what that means is that if it does correct below 8%, it probably is not a winning stock. It's probably not the right idea for you. So which is why, and of course, like we saw in the first example that we mentioned here, the example of Tata Elxsi, by booking our losses at 8% in that stock and realizing that we made a mistake in that buy recommendation, we protected ourselves from a 50% loss. So now remember that don't get too demotivated by making 7 to 8% losses once in a while, because the idea behind the 7 to 8% rule is that it's designed to protect you from further losses. Another thumb rule that we can keep in mind is to follow a 3 to 1 profit to loss plan. So what we say at MarketSmith typically is that we try to book our profits at 20 to 25% gains. So now what that means, if you divide that by 3, what that means is that we should book our losses at 78%. So try to keep, even if you don't want to follow 8% and you want to follow some other percentage rule, keep this thumb rule in mind and keep this 3 to 1 ratio. Try to book your profits at 3 times what you typically book your losses. So for example, if you plan to book your profits only at 30%, then make sure that you book your losses at not more than 10%. So if you bought a stock and it goes 10% below your purchase price, you should be selling it, no questions asked, without any doubts in your mind. We'll talk a little bit more about this 3 to 1 ratio and the 3 to 1 profit to loss plan in our next session as well. Okay, so here is what can happen if you hold on to your losses. I see quite a few questions in the chat. I'll come to that in a few minutes. So just please have some patience. Okay, so coming back to this, what to do when? Why do we say that you should book your losses early and not let our losses multiply? So we need to keep in mind that compounding always happens in the market. So compounding is something that is constantly at play. So what happens if the stock is down 25% from your purchase price? Now what that means is that in order for you to break even, that stock has to rally by 33% from there. So what happens if a stock is 50% below your purchase price? Now what that means is that for you to break even, the stock has to actually jump up 100%, or the stock has to double just for you to break even. Now, how often do you see that happening? How many stocks can you identify that have given 100% returns or that have doubled? So it's very rare to have this kind of 100% return. So in order to protect ourselves from these kind of situations, that's why we make sure that we always cut our losses at a small level. Notice that if we cut our if your losses is just at 8%, the stock needs to go up by only 9% for us to break even. So that's still kind of manageable. It's a much better win loss ratio compared to 25% and 33% or 50% and 100%. So that's why we always make sure that we book our losses when they are small. So if we keep letting our losses multiply, we are just getting deeper and deeper into that hole, and that stock has to rally so much more in order for us just to break even.
Here is an example of Just Dial weekly chart. After its IPO, the stock has had a very good run. It has had a nice spike in its price. It went almost up, and after that it had a dip in its price, and where it fell below its 200-day moving average. Post that, the stock again moved back up. That is when we took a position at this stock, that is at the price 1779. So right after this proved to be a bit, it was not that good for us, and it started to make losses right after we took a position in this stock. So in the next couple of weeks, we saw that the stock fell by 8%, and we cut the position at this, we cut the stock from our portfolio at this position. So after this, we see that the stock has continuously trended downwards. Like if you see this, the stock has almost given up all the profits, and it fell drastically to almost it gave up more. It also fell below its IPO price. So this is what Arun was speaking of a bit earlier. If we let the losses go down deeper, we see that it will hurt the overall portfolio returns, and we should identify the stock when it is showing technical weakness. And also, if we see at this point, the stock's downside volume has been picking up. So this is another indicator of how the stock came under pressure, and this is an example of why we should cut down our losses to 7 to 8%.
Yes, that's correct, Raghav. Actually, what you see here is that by selling it at 8%, just like we saw with the Tata Elxsi example, by booking small losses, we saved ourselves from much bigger losses in the future. Okay, so I'll come to the questions on the chat. So I see this question from Rajiv. So he's asking, what do we do when you're averaging up at various price points, and how do we calculate 8% from there? So in case you are averaging up, we say that at each of your purchase decisions, at each of the pivot price that you have bought, or if you have identified the right buy points and bought as the stock breaks out, keep a tab on what those pivot prices are. So say you bought an initial position, and then you averaged up and added more to that position later. So now the point that you bought it later, keep that price in your mind. And if it falls below that level, 8% below that price point, that's when you need to get rid of that position. You need to get rid of that additional position that you had built on that stock. You would already have some position in which you have some profits. Now, whether you want to sell that as well is up to you. You have to ask yourself the question, say if I had 25% gain in my initial position, am I okay with that gain falling down to 19% or 20%? If you are okay with that gain falling to that level and sitting through a small amount of consolidation and giving up small amount of your profits, then yes, you can hold on to that initial position that you built up. But if you don't want to suffer a loss in that as well, then if the most recent breakout has failed, by failed I mean that the most recent breakout, the price has fallen 8% below that, then you can get out of your entire position and book your entire profit there itself. Now, if you are following the first option and saying that I have a decent amount of profit on this and I'm okay to give up some of that amount away. So even in that situation, you need to take a look at that chart and be very careful, and you need to decide beforehand at what price are you going to get rid of your initial position. Now you cannot get rid of, you cannot let all your profits go into losses and then sell that position. That means you just wasted your time in that stock altogether. So you need to have a look at that chart carefully and decide at what level am I going to cut all, what level am I going to take all my profits. It could be one of the moving averages where it has found support earlier, or it could be a particular price level where you see that the stock has historically found support earlier. So I hope that answers your question, Rajiv. Yeah, so this is all about pyramiding. So by pyramiding, what I mean is that if you buy an initial position, the next position you buy, when you average up, the amount that you invest at that time needs to be lower than the amount that you invested initially. Now that is going to protect you in these kind of situations. Say the second buy point did not work very well and it fell 8% below that. Now that would mean that you have actually invested a smaller amount at that level. So overall your profits would be better rather than if you had invested a larger amount at the second buy point. So by pyramiding up, we are kind of reducing our risk level. So at each secondary buy point, we are investing a lower and lower amount. So I see this question about where should your stop loss be. Yes, stop loss should be just below your support level. So if you can look at a chart and identify a particular support level, and this price falls below that, then yes, that's when you should get worried. But there can be situations when it pulls back to exactly that support level and then rallies. So yes, when you're looking at stop loss, you should be looking at, is the stock falling below that level or not. Now, also when it comes to support levels, you need to make sure that your support level is not too low. Like we said earlier, always nothing more than 8% is what we always advise. So don't look at a support level that's say 15% below your buy position. Like in the chart that I showed you earlier, the more losses you have, the stock has to rally so much more in order for you to break even. I see another question about Kelton Tech, about when exactly we added it to our portfolio and when we removed it. I'll get back to you on that a little bit later. Right, I see a question from Sahil. He says that when a stock peaks, it does so with huge volumes, and we say that huge volume and the stock going up is always good, but just after that the stock starts to slump. So Sahil, I believe what you are looking at is what we call a climax stop. Uh, I'll just tell you in brief what a climax stop is right now, and we'll be going over climax stops in our next session in a little bit more detail. So basically, a climax stop is when the stock has been going up for some period of time, and then suddenly you see that it's starting to rally a little bit too much. You will see that the daily gain for that stock, the difference between the low and the high on the daily chart or on the weekly chart, is the highest that you have ever seen in the history of that stock. Or you will see that the chart has been going up for some time and suddenly it accelerates even further. You will see a kind of parabola shape happening. So these are all kind of worrying signals. These all indicate that it's getting too much overheated and there are just too many people trying to buy that stock at that point. So that is actually a negative signal and we call that as a climax stop. It's actually rare that it happens in the market. So you won't find so many examples of climax stop. But we will be going over that in a little bit more detail in our next sessions. So I'll go back to the chart for Hilton. Yes, in fact, you can see here this line you see. This is the biggest difference between the low and the high ever in this chart. So for this week, this was the largest ever difference you see from that low and that high. So yes, this can be called as a climax stop in this case. It has rallied for quite some time, and then suddenly it gets much more. You can see that it's getting really overheated at this point.
Also in this case, what I observed is the stock has not made any base. If you see, the stock made a base over here, it made a cup, but after that it has not consolidated and has ran up like for next few months. So ideally we would take a position only when it breaks out of a proper pattern and that didn't happen in this case. After this, the stock didn't consolidate, or else it just went above like this. So this is ideally here is where we would take a position, and post this there was no ideal entry point for us to enter the stock. So that is where our base pattern comes into picture. So that is why we stress more on proper breakouts to take new positions.
Okay, so moving on, how does the market affect our stock positions? So what we see is that when most of the stocks will follow what the market is doing. So 3 out of 4 stocks will follow the overall market trend. So if the market is in a confirmed uptrend, most of the stocks will be moving higher. Whereas if the market is correcting, most of the stocks will be correcting along with that market. So now this is all about probability. Now, if you are buying stocks, don't we want to make sure that the probability is as much in our favor as possible? So how do we do that? We do that by making sure that we buy it as the stock breaks out of the correct base pattern, and of course by making sure that the market is in a confirmed uptrend when we make our buy decisions. The opposite also holds true when the market is in a correction. Most of the stocks are going to go down with it. So when you know that the market is in a correction, and we have changed on MarketSmith, we have changed the market status to a confirmed downtrend, should you really be trying to be invested 100% invested at that point? Because at that point the odds are not in our favor. It doesn't really pay off to play with that kind of odds. So 75% chance of all stocks moving down when the market is in a correction. Do you really want to be 100% invested at that point? That's the question that we need to ask. So how do we deal with it? So what do we do to our portfolio when we see that the market is starting to correct? Of course, if the market is moving weaker, it doesn't mean that we need to sell all our positions and get completely out of the market. It means that we need to get cautious, and we need to make decisions about when are we going to exit each of our positions. So what I would say as an action plan is when the market status does change, take a close look at all the stocks in your portfolio. By a close look, I mean just have a look at all those charts and identify at what point are you going to book your profits, or at what point are you going to cut your losses, and stick to that initial plan. Don't get carried away by emotions, and once you've identified that point and you see that the stock is reaching to that point, uh, just execute that trade and complete that decision making. So if you find that you are a little bit of an emotional person and you are not able to follow through on these kind of trades, I would advise that you can punch in your orders beforehand itself at those particular price levels, and the market will take care of the rest for you. So what do we do when the market is correcting? So keep in mind, how is your stock behaving? Is your stock starting to correct along with the market, or is your stock only consolidating? Do you see signs of weakness in the chart? So we'll come into what exactly do we mean by signs of weakness in the chart, and if you do see signs of weakness in the chart, you need to be thinking about getting out as well. Also, do you see the trend changing? Again, we come to what do we mean by trend changing. What we are looking for is that the stock has behaved in a particular way historically by looking at that chart, and now that behavior of that stock is changing. And also we need to look at what are the other stocks in that particular industry doing. So if in a particular industry you have a stock from a particular industry and all the other stocks in that industry are starting to correct, then we need to be aware that the stock that we hold, that also might as well correct. So we need to be aware of that, and we need to be careful to book our profits or stop our losses at the appropriate time. So coming into our action plan, if you are sitting on big gains, what do you do? So if you have good gains in one of your positions, like I said earlier, you need to study the chart of that particular stock and decide at what point are you going to book those profits. Now, at what point do you book? Uh, that can be up to you. It can be one of the moving averages, or it can be one of the historical support levels where the stock has usually found support. Uh, but of course, it's very important that once you identify this point where you're going to sell, and you've decided that you will get out of that position, you need to be sure that you in fact follow through with that trade and you actually do get out of that position. Now, the trap that can happen here is that you decide that I'm sitting on 25% gain and the market starts to correct. You might think that I'm okay if it falls down to 20% gain. So now if you have decided that up to 20% is okay with you, you should not let that 20% become 19%, because then what will happen is that your emotions will get better of you, and then you will wait for it to, for you'll wait for 20% to become 19%, then it'll become 17%, then it'll become 15%, then one day it'll become 10%. And then so basically you're giving up the majority of your gains. So that is just counterproductive. You don't really need to do that. And so once you decide that I'm okay with this level of profit and I'm not okay if it falls below that, you need to stick to those decisions. And talking about small gains and losses, if you see the market moving into a correction, there may be some stocks that you would have bought a few weeks back or very recently, and you might have small profits on those or small losses on those. Say your profit might be something like 5% or 4%, or you might have a 2 to 3% loss on that investment. So these are the ones that you need to get out first. So this 5% gain or this 3% loss, that can very quickly turn into an 8% loss or a 10% loss. So you need to be careful about those, and you need to be selling those positions first and not your winning positions first. So hold on to your winning positions as much as you can. Of course, you be ready to sell them if they are breaking below support levels that you have identified. And your positions that have not given too much of gains for you, you need to be selling those sooner. And of course, regardless of market correction, 8 to 7% sell rule will always apply. Uh, I know it's a very tough rule to follow, but just remember that the rule is there in order to protect you from further losses. And also keep in mind that as a retail investor, even if you get out of a position, it's very easy to just get back in whenever the stock breaks out again. So you can always get out and get in very quickly. So Sahil, I see a few more questions from you. You're asking about what do we do when the stock nears moving averages. I think it will become clear when we look at the following examples, which Raghav will take you through right now. Okay, so I'll just talk about what are the sell signals that we've been mentioning sell signals throughout. So what are the sell signals that we mean? So one of them is breaking below the moving averages. What we typically follow here is the 10-week moving average, which is the same as the 50-day moving average, or the 40-week moving average, which is the same as the 200-day moving average. So now if we see the stock breaking below one of these moving averages on heavy volume, so it's falling down on heavy volume, now that's a very worrying signal, and that is a sell signal that we keep in mind, and that could be one of the triggers that we use to get out of a position. Also, we can look at a change in trend. Again, what I mean by change in trend is that study the chart as it has behaved earlier. We identify that it has behaved in a particular way before. Say, for example, it has always found support at the 50-day moving average, or for example, it has always found support at 120 rupees, and it never falls below 120 rupees typically. But this time it has changed. This time it has fallen below the 50-day moving average, and or this time it has fallen below 120 rupees. In that case, that is a signal of a change in trend. So that's another sell signal, a sign of trouble that can be used as a trigger for you to get out of your position. And another kind of more obvious trigger is a gap down on heavy volume. Now, a gap down is nothing but when you see, for example, if today is a gap down day, you will see that the high of today's intraday high would be lower than yesterday's intraday low. Now, what that means is you will see a clear gap in the chart. If you were looking at the chart, you would see a gap in the chart between the 2 days. Now, if you see such a gap down and if you see that the volume is high, now that's a very worrying signal, and that indicates that some bad news has happened and something really wrong has happened with this company. So that's another sell signal that we keep in mind. So when we see these kind of gap downs, we need to get worried and we need to think about getting out of those positions. Now, in the following examples, we'll go through all of these sell signals. We'll see all of these sell signals in action, and I guess that time it'll be a lot more clear to you by when do you exactly sell your stocks.
So in this example, we'll see that how the moving averages help you in cutting down on positions. So as Sahil asked earlier, how does 50-day and a 200-day moving averages help you in cutting down your positions of stock? So here if we see the stock consistently found support at its 50-day moving average over here, right after that again over here, and in the past it has found support at these at this 50-day moving average. So this is like a trend that we have to keep in mind. So we have to observe how the stock has acted in the past. We see that it has found support at its 50-day moving average. So once we see that there's a change in the trend, if you see over here, there's been high downside volume and also the stock has breached its 50-day moving average. So this is where it has changed its trend. So it has been following a trend right through this, and after that it fell below the 50-day moving average. So once it has moved from its trend, we see that there's a new trend that it has followed. So if you can connect all these lows here, we see that it has been trending down. The stock has trended down. So gradually we see it has also breached its 200-day moving average, which is a very worrying sign. So that is when it is a sign where investors should think whether to stay in the position or book profits. So though the stock has had a very good run, there might be some fundamentals or something, some news about the stock that has caused this weakness, and suddenly you see a distribution in this stock. So this is how you take decision based on the 50-day and 200-day moving averages. This often happens with stocks that have had a very good run. For example, if a stock has given you good returns, if you have entered the stock after it broke out from this pattern, the stock gave pretty good returns right through. So, but you at this point of time, you would have to think like, do I hold this position, or else do I remove it from my portfolio? So though I mean in a previous slide you've talked about how to cut down on losses when the stock goes 7 to 8% below the purchase price. So in this case, what happens is, though the stock has rallied way up from its purchase price, we don't have to sit so that it comes back down from its purchase price to remove the stock. So we have to be alert and be cautious and understand its chart pattern and see that whenever the stock breaches its 50-day or 200-day moving line, or whenever the stock moves out of its pattern, that is when we have to be cautious and remove this book up profits. So after this, we see that the stock has trended down, and ideally exiting position from this point will help us book profits and avoid losses.
Just to add on to this, that does not mean that we are going to sell it exactly at the peak. If you see what happened here, the peak was around 900 rupees, whereas if you look at the sell signal, that was around 600 to 700 rupees. So we did give up some of the gains on the stock, but it's not really a perfect timing, but it is a good timing. So by good, I mean that we protected ourselves from a bigger loss, and we were able to book the majority of this rally.
Here is another example of Eros International. It's a daily chart of the stock. Arun was earlier speaking of gapping down. So here in this chart, we can see numerous times the stock has gapped down. So by gapping down, it means that the day's high is lower than the previous day's low. So if you see the day's high here is lower than the previous day's low. So this has caused a gap down effect. And this is another alarming factor where investors should be cautious. So generally this happens when there's some bad news about the stock or the industry, or sometimes even when the earnings result is not as per the market expectation. Even then we see that the stock goes through this case. So this is when investors should be cautious and see what is the news that has affected this gap down, and then accordingly we should analyze and see if this news will have a long-term effect, and depending on that we should take a call. So this is another rule that we follow at MarketSmith, where we look at gap downs and analyze what is the news about this. In gap down also, the other thing we can observe is whenever there's a gap down, it is always mostly on the high volume. So if you see this gap down here, there's high volume, above average volume, and also in this gap down you see above average downside volume. So this is another sign that investors should be wary of, and they should be alert enough to remove positions of such stock which gap down. Also, other than this topic, what I would say is we also sometimes come across gapping up as well. So that happens when there is some good news, or else there's some good news about the industry, or there's earnings. When earnings exceed market expectation, even in that case, we see that there's a gap up. So that also benefits the portfolio because suddenly there's a spike in volume. So this is another sign where we have to be cautious of. Okay, so this is an example of Kajaria Ceramics. It's a daily chart of the stock. If you see, the stock has had a very good run here. It has trended nicely up, and it has always stayed above its 50-day moving average and towering well above its 200-day moving average. So the stock has gone up very well, and people who are taking, who would have had positions in this stock, they would have sat happily at this position. But suddenly we see that after it topped at this point, the stock drastically fell. So if you see, this is huge drop down in the stock, and also the volume has been very heavy. So this is nothing but when we see a stock falling by a great margin and also on very high volume, that is nothing but a big sell-off. It is a sell-off on high volume. So this is not a daily scenario. This generally happens when there is some bad news about the stock, or there is something negative about the stock. So this is another case where we have to be really careful of, and we should see when the stock is happening, and we generally, investors, a normal investor would let the loss go deeper, and this would affect the overall portfolio return. So we should always stick by the sell rule of 8 to 9%, and eliminate stocks which have hit that stop loss. So, and also in this case, we see that the stock has also breached its 50-day moving average line. So that is another signal where investors should ideally exit out of this stock.
Yeah, that's right, Raghav. So what we see here is that the stock has never pulled back to its 50-day moving average over a very long period of time. So this is a really long uptrend that we see. Yes, this is a daily chart, so it looks a little bigger than it actually is. But this is still a kind of a sustained uptrend that we see here. It never really came back to its 50-day moving average, but on one day it closed below its 50-day moving average, and it was a very heavy volume down day. So that itself is a sell signal on its own. So this by itself will make us cautious, and we could get out at this time, given that we have this signal here. So just one more chart showing you about how changing in the market conditions can protect us from losses. So this is what happened in 2008, 2009. So the Sensex corrected over 50% in just 14 months. So we had changed the market condition somewhere here. So like I said earlier, it's not that we are going to get the exact peak right using our sell signals. There will be a little bit of delay, but that said, that does protect us from further downside. So that's very clear when you see this chart. So we did not change the market condition at the very peak. We changed it a little, maybe one week late, it looks like, from this chart. But that in fact protected us from this 50% drop over 14 months, this drastic correction that you see here. So by calling the trend change here, we saved ourselves from this kind of situation.
So around the same time, this is an example. This is the example. This is the chart of Sensex weekly. So this was a time when there was subprime crisis, and overall global markets were all weak, and the effect was also seen on Indian markets. So the Sensex was trading at a good high, but however, right after this point, the Sensex started to trend down. It also broke below its 50-day moving average, and here we see a death cross here. The 50-day moving average line has cut across its 200-day moving average line. So this is ideally a situation where we changed the market status from a confirmed uptrend to under pressure, and over the time we've also moved it to correction. So this clearly shows how market has how the frontline index has given most of its value and trended down by 50%. So whenever such thing happens, whenever there's a market weakness that is shown through the benchmark indices, we should be very careful in taking new positions. So benchmark indices shows an overall view of how markets are performing in a particular country. So for example, in India, the Sensex and Nifty are currently at their all-time highs. So it shows that along with the benchmark indices, we see that many of the stocks are also scaling their all-time highs, and it is a very strong Indian market currently. However, in this case, the indices have trended down and have were under pressure for a long period of time. In this situation, it is ideal to wait and watch how the markets react and take only positions in stocks that are really good and which show fundamental strength. Otherwise, we would not suggest to take any positions when the market is weaker.
Okay, so again, this explains why you should not be fighting going against the market. Like we said earlier, during a market correction, most of the stocks will be going down along with the market. So you can see the kind of so these are all good companies, leading companies, and you can see the kind of losses that they suffered during this correction that happened. So even good stocks will correct during a market correction. That's the point that we're trying to make. So when we do have the market status as unfavorable, it's in a uptrend under pressure or it's in a confirmed downtrend. So we need to be careful during those phases. We need to be thinking about getting out of existing positions, and we should not be building up new positions during that phase because it's just that the odds are against us here. So once again here you can see what happened to ICICI Bank and how just the change in the market affected this stock. So this was when we changed January 2008. This week was when we changed the market condition. So the stock has been rallying prior to that. It was doing fine, but on that week where we just after the week where we changed market condition, it broke below its 50-day moving average, and then it never recovered from that level. It tried to retake. It in fact went below its moving average for some time, but it eventually corrected and came back down. So now this is a really, I mean, there is nothing terrible about this company. It's a healthy company, but still, just because the market was correcting, it can correct along with the market. So you can see that this stock, after breaking below that 50-day line, it dropped 80% in just a span of 14 months. So we are nearing the end of our session for today. So just to, I will mention where you can learn more about selling. I would suggest you read the book about how to make money in stocks by William O'Neill. It's really explained in much more detailed way than I can put across to you during this webinar. So I suggest you read that. So it will talk about why you should cut your losses without exception, and it will also talk about how you should sell in order to book your profits. Also, we have MarketSmith University, so we have seminars happening at our office in Bangalore every month, at the end of every month. So during these seminars, of course, it will be a face-to-face session, so it will be much more interactive. You will get to ask a lot more questions, and I'll be able to give a lot more attention to you in answering your questions. And we can go over a lot more examples in those seminars as well. So I suggest you attend one of those seminars if you're interested in learning a little bit more details about any of the topics that we're talking about. So that's about this session. Coming up next, this was only the initial part about selling. So in our next session, we'll talk about how do we sell in order to book our profits. So what we talked about today was defensive selling. And next time we'll talk about aggressive selling or selling on the way up, selling while in order to lock our profits in. And we'll talk about the 3-to-1 profit loss plan, how we should make sure that the ratio between profits and losses is always at this 3-to-1 ratio. And once again, we'll talk about how to spot when the chart is topping. Like we talked about climax stop today briefly. We'll talk a little bit more detail about climax stop in our next session as well. So that's all for today. I'll go over some of your questions. So yes, for when talking about the indexes as well, when talking about Nifty and the Sensex, yes, we do keep a track of the 50-day moving average. I would argue that we give even more importance to the moving averages when we are talking about index, because it's really about how it has been behaving historically and how the trend is changing now. So that is, it's all about studying the chart and finding out that it has found support at this level earlier, and now it is no longer finding support at that level. So I see this question about how we should trade during a downtrend. What we say is just don't trade during a downtrend. So if the market is in a correction, get out of your positions in the way that we talked about today by booking your losses first and then booking small profits later and then booking your larger profits last. So get out slowly from the market when the market starts to correct. Don't build up on new positions when the market is correcting, because again, like I said, the odds are against your favor. You should not be trading when the market is in a correction. In fact, what you should be doing when the market is in a correction is building up a watch list. So when you can't see good stocks breaking out and market is not favorable, look at the fundamental characteristics of your company. So a bad market is giving you time to really dig in and find out about good companies that have great sales and earnings growth and that have really good stories behind them. And so the correction is just giving you time to build up your watch list. And as the market starts to become favorable, then you will see these stocks breaking out of base patterns. And as they break out of those base patterns, that's when you'll enter it and that's when you will start building new positions. So in short, use corrections to build up a watch list and don't trade during corrections. Yes, I see another question about gap down. So I believe the question is about buyers coming back and the stock closing at the high during that gap down. So yes, if you see a gap down and eventually the stock it reverses and it actually closes at that day's high. So now that is a positive sign. But then you need to ask yourself, if it really is a positive sign, why did it not recover and close in profits for that day? So if really all investors change their mind about whatever bad news came out on that day, then the stock would have closed positive or flat and not negative for that day. But that said, yes, a gap down and closing at the top of that day's range is a positive sign, but still it does not mean that you should not be cautious. Any gap down is a place for you to be cautious, and you should be thinking about selling at that point. If not at that gap down day, maybe you can see that what does the stock do over the next few days? Is it really something has changed and buyers are coming back? If you see that over the next few days also buyers are coming back and you see the stock is starting to move up on higher volumes, and then yes, then it makes sense to hold on. But then if you see that buyers came back for that one particular day and it closed near the day's high, and then for the following days the stock is kind of volatile, it's not really showing any sense of direction, that is, you should, that means that people are not really sure about what to make of it. In that case, you should be, it could happen that the stock could correct, or it could happen that it consolidates for some time. So in both those situations, when the stock is correcting, so obviously that's a bad sign for us. In that case, we want to get out. If the stock is going to consolidate for some time, now why do we want to sit through that kind of consolidation? As a retail guy, you can always get out and get in at the next breakout. So that is one of the best advantages that you have as a retail investor, is that you can always get out and get in a very quick span of time. So you can make your decisions quickly and you can execute your orders quickly. So use that to your advantage to time your buying decisions in the right way. Yes, not completely. I mean, it's up to you whether you want to completely liquidate your position. Like I said earlier, you need to liquidate those positions that have small gains earlier. So the ones that have 3 to 5% gains and you're still sitting on them, those should be the ones that you sell first. And the ones that you have 20, 25% gains, 30% gains, those are the ones that you should be selling later. But that said, even if you are not going to liquidate your entire position, you need to look at those charts and you need to decide at what point am I going to sell this, and you need to stick to that decision. I see this question, how much of your total fund should be kept in cash at all time? So when it comes to our methodology, what we say is that don't have too many stocks in your portfolio, but when you bet big. So if you have just a few stocks in your portfolio and those turn out to be winning stocks, that can really fetch you really good overall returns. So over diversifying is just, it will just make your portfolio a little bit more sluggish. If you have too many stocks, it will mean that your portfolio is going to move a little bit slower. You will not get those kind of huge gains that you would get if you had just had, like, for example, 4 stocks that really did well. So I'll give you a quote by William O'Neill that I think encapsulates this first. So he says that diversification is just a substitute for ignorance. So what that means is that you should be very sure about the stocks that you're buying. You do your research well, buy it at the right time, and if you do everything right, you should, if you are really confident and you do everything right and the story is in place, you should be betting big at that time. So if you identify a really good idea, you bet big, and then if you bet big, the 20-25% gain is going to really make a lot of difference to your portfolio. Yes, exactly, Sai. You said that even during the downtrend, ICICI did make basis, but it kept slumping down further. So that's what we mean when we say that when the market is in a correction, most stocks will tend to go down along with the market. So yes, stocks will continue to make basis while the market corrects, but the probability of the stock moving higher and breaking out of that base is lower. So there's no, it might break out of that base, but the chances are higher that if it's going to correct and make another base or going to slump down further, like you said. So that's why we say that you should not really be buying breakouts when the market is in a correction. So yes, Rahul, exactly that's what we'll be talking about in the next webinar, about how to book profits when you are in profits. How do you get out and make sure that you lock in those gains? And it doesn't really matter whether you're talking about small or mid cap. All these principles, price volume action, buying the stocks as they break out of base, getting worried when the selling volume is high, getting excited when the upside volume is high. All these principles apply to all stocks, whether they are large or whether they are small. We need to keep in mind that our methodology is mostly based on the behavior of investors. So there is a lot of behavioral science behind these buying and selling decisions, behind all these base patterns. So all behavioral science remains the same, whatever the stock is, whichever exchange you're trading at, whether you're trading in London or whether you're trading in India, or whether it's a large cap or it's a small cap, all those factors are going to remain the same. I see one more question here. How do we know when that steam is going away from a stock? Again, this is something that we'll go over a little bit more detail in the next session. For now, what I can tell you is study the chart and look, like we use this phrase in MarketSmith, has the characteristics of the chart changed, or is the chart changing its behavior? So that's the question that we need to ask. Is the chart behaving in a different way than what it has previously behaved historically? Like for example, we see historically that there is a particular price level where the stock always finds support. Now, if the stock no longer finds support at that price, then you should be thinking about getting out of that position. I see another question about whether RSI divergence can be used. Uh, we actually keep a track of a lot of technical indicators here for our portfolio. So we do look at RSI and all those things, but that is just a sort of secondary thing. We don't really make decisions based on RSI and those other technical indicators. All our decisions are sell decisions or all our buy decisions. Like all our buy decisions are based on whether the stock is breaking out from the right base pattern and does it have all the Cancelam characteristics that we look for. In the same way, all our sell decisions are based on is the chart changing its characteristics? Is it breaking below support levels? Is it showing major signs of technical weakness by breaking below its moving averages? Now, these are the things that we base our decisions on. But that said, we do keep an eye on RSI and all those other technical indicators just to get an idea about what the market is doing. So I see another question. Once you are at 25% profit, should one hold on for more or book 50%. So this is something that we had covered earlier. So what we typically say is that book your profits at 25% and then enter it again once the stock breaks out from the next base pattern. Now there may be situations where the stock rallies 25% or more within a span of 4 weeks or less than 4 weeks. Now when that happens, that is an exceptional thing. So when that kind of exceptional thing happens, we say that this could be a really big winner and there is a really strong momentum in this company. There is a really strong momentum for the stock. In that case, we say hold on to that stock for a longer period of time, at least 8 weeks time, and see what kind of gains we can get out from that. So yes, book at 25% profit, but if it has gone 25% in 4 weeks or less, then hold on to it and see where that stock can take you. So I see another question as there may be stocks that don't have good EPS growth and ROE and yet they are in our model portfolio. Uh, Now, all the scores, like for example, EPS score and master score, that compares any stock to all the other stocks trading in India. So EPS score would be based on what is the EPS performance of this stock compared to all the other stocks that trade in India. Now, if you're looking at any particular stock, you need to keep in mind what is the industry doing. So now, if you're looking at something like a developer, the kind of EPS growth and sales growth that you will see in a developer or in something like a food company or a staples company, say you know a supermarket or something, you will not see or a very large retail company, you will not see the kind of double-digit sales growth and earnings growth for those. So you need to keep the industry in context as well. So what we look for is does the growth of this company look good compared to all the other stocks in that particular industry? So if the answer is yes, so if the stock is having uh, good growth compared to its competitors, then yes, then we're interested in it. So it's all relative to what the rest of the industry is doing. And of course, another thing that we need to keep in mind apart from fundamentals is the N factor as well. So N is actually uh, I would say it's the most important part of the canceling methodology. So N basically is why are investors excited about that stock? What is new about that company? What is so special about about the story of that company? So that is something that if N is really strong and we are really happy about that N, we may sometimes overlook the other C and A factors. Now that is, it does not happen all the time, but if N is really that powerful, then that we should not be ignoring companies just because the C and A does not exactly fit into our methodology. Okay, so I think we'll end it for today. Our next session will be in 2 weeks' time. I believe an invite will be sent out by email to all of you for if you're interested to attend it. Uh, it's typically held on every second Tuesday. So thank you all for joining us today. Please do check out our app on the Google Store. You can download it for free, and it will really help you. I mean, it really helps you make use of our methodology by giving you the right ratings and trackings. It gives you, in fact, it gives you pattern recognition. So it gives you a lot of things, in a very easy to understand format. So please do check out our app. And once again, thank you for joining us today. It's ended.
Yeah, it's fine.
Yeah, good job. Excellent. Just a couple of things. One is this question on first you compliment, that's a very good. Always make other person feel ego. Like, yeah, great question, and I'm glad you're noticing all that. And that's why, thumb rule is you should always look for earnings. We always focus on that.
Storms.
So this is a great question, and I think